The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. Equity markets in Asia plunge, with South Korea's Kospi posting its worst day ever. Let me say that again, worst day ever, as investors dump tech names and chip makers on rising inflation fears as war in the Middle East intensifies.
The US and Israel continue their assault on Iran, with explosions heard across the capital. President Trump raising questions about the administration's post-war plans for who should lead Tehran.
Most of the people we had in mind are dead. So, we had some in mind from that group that is dead. And now we have another group, they may be dead also, based on reports. So I guess you have a third wave coming in. Pretty soon we're not going to know anybody.
President Trump offers risk insurance for maritime trade in the Gulf and says the Navy will escort tankers through the Strait of Hormuz in a bid to ease soaring oil and gas prices.
We've got huge moves across on the Asian markets this morning. Don't forget the South Korean market opened up yesterday, swiftly lost 7%. But today the selling has stepped up and now it is the worst trading session ever for the South Korean market. The selling there you can see down to the tune of 12%. So the market is seeing the opposite trade from what has transpired for the last year plus, where we had the market that was the best performer in the world last year, up 75%. Continued on with gains of double digits this year. We had warnings from some investors saying be careful of a market that goes up that much. And today, as we take stock of what is taking place here, that effectively the US dollar's strength is undermining some of these emerging market trades. And this is the one that truly has been magnified. You saw it in some of the other markets there on the screen as well, but the Kospi in particular is the one under the most pressure. Now, what has been supporting some of these names? It has been those chip makers in South Korea, but even with the optics around Iran, even with what is taking place geopolitically, the market cannot comprehend the memory chip crisis that is playing out in that part of the world. It's just simply been pushed to one side. Valuations are now in doubt, and the market is selling these chip makers, SK Hynix, Samsung, TSMC, some of these preferred trades across the region this year, down, as you can see, a fairly mighty more than 9% on the likes of SK and 11% on Samsung. And that is undermining the direction you're seeing on some of these markets. I mentioned South Korea, but Taiwan, don't forget, the TAIEX has been one of the preferred trades in the region as well. Now, WTI Brent gold. This has been where we've seen the appetite to the upside. It's retail traders going into this area of the market too. Typically a place for a lot of the institutional traders on the back of a conflict like this. But you were seeing it coming through from retail money too. We stepped up about 4.5% yesterday, another 2% today, 3% on Brent. And don't forget, even with this promise now from President Trump around offering insurance to shippers going through the Strait of Hormuz and Navy escorts as a potential, it is not causing the price to flip lower. There's still significant concerns around supply. Now, gold, before we move on, this was fascinating yesterday. We saw some pressure on the gold trade. There was a view that it was a race towards cash and that investors were liquidating what they could. Gold, of course, has been, again, one of those monster trades in the last 12 months plus. So money was coming out of gold yesterday. This morning, it has again found a threshold 5174, but again, off the heights that it's seen in recent weeks. To what we're seeing on the US markets, it is interesting to see just how contained the US picture has been. Even in Europe yesterday, we weathered much larger selling than this. It was by and large less than 1% on the Dow and the S&P 500 and just over that amount on the NASDAQ. Early indications were for much deeper selling, and it was during the session yesterday when the roller coaster transpired. We saw much larger selling taking place before that slight recovery trade came into the mix later in the session. So we're certainly a now biting ride for that intraday trade, but the wash up as you looked at the finish it was much more contained. In terms of the European markets, this was the opposite story. We saw selling in the session, the selling ramping up across the course of the trading day. Eventually, the German market down 3.4%, 3.5% off the French market. It is that oil story and the concerns that, look, Europe is in a very different position to others. It is reliant on this part of the world for the diversification away from Russian energy. And that means we're talking about potential hit to the economic situation in Europe, to the inflationary picture. But this morning we are seeing green march back onto the boards. It is, again, very slim ranges considering the extent of the losses that we saw yesterday, but it is an upbeat move anticipated this morning in Europe. Let me take you to US futures. Now, the picture this morning suggests, again, some caution. So a little bit of red, but again, those ranges have just started to trim back, and we're looking at a decline of about 0.5% on the S&P, a little bit more again off the NASDAQ. So, Steve, those high flyers to me are the ones where markets are just pulling back aggressively still.
I want to take a step back because I value everything you've just said at the wall, and you've been looking at the Kospi for a few days and wondering what's the catalyst. And I think the catalyst and the reason for the fall aren't necessarily the same thing. Bear with me. The catalyst being the initial lighting of the touch paper, but the reasons for the fall can be a lot more sophisticated. And you've been alluding to it for days. And there's two reasons why I want to do this. One, is Kospi falling because of events in the Middle East? I don't think so. I think that is the touch paper. And again, you've alluded to this for days as well. So I think you're all over this one as well. Is it about margin calls? Is it about leverage? Is it about valuation? Is it about tech and AI fears and about the semiconductors just having come too far? And again, you've been raising all those questions. But the reason I raise it is because actually, despite the fact that during the European session every day, the US markets have been falling so aggressively, but they've actually rallied quite hard into the latter part of the session. So even though we're down over a 3-day period on the US markets, we're not down anywhere near as much as, for instance, the Kospi. So my question is really, and you don't have the answer any more than I do, but I think I value what you want to say about this one as well, is that should we be looking at the Kospi as a metaphor for what could happen in US valuations and US tech? If we see anywhere near the kind of moves that we've seen over in Asia, in the Kospi, in South Korea and elsewhere, then that could be extraordinarily difficult for many investors.
Well, Steve, for me, the interesting part of the equation here was gold. Typically in a moment like this, you see the market buying the safe haven. So the fact that investors were cashing out of gold to liquidate does tell you something. Where you've had the money that has been banked has been around the South Korean market. That is where you would typically think investors would sell because you have had such extraordinary gains over the past 12 months. So to me, it's obvious that you're seeing such a huge pullback there. Less obvious was the gold equation, but if everything is selling off, I think it does make sense that investors are baby up with the bathwater territory. They're selling pretty much everything. The South Korean situation is interesting, though, because as we still have these questions around AI obsolescence, South Korea is in a different position that we do know we need the memory chips. That is where the supply chain crunch is. Does it even get worse with the situation in the Middle East? Or does it abate because we may see some impact to AI orders thanks to the geopolitics? Again, that's the moving piece, I think, around South Korea. To your point around whether the US markets then sell off, that is a good question. I mean, if you're going to sell South Korea because you're concerned around the AI story value of valuations, do you go right back to the heart of it, to the NASDAQ? And you are seeing a little bit of pressure on that US index.
Yeah. And so if I was a US investor today, that is exactly what I would be asking. OK, the conflict in the Middle East has entered its 5th day, with Israel saying it's carried out a wave of extensive strikes against Iran overnight, targeting infrastructure, defense systems and missile launch sites. The Trump administration has continued to offer a shifting narrative as to the justification and objectives of the war, amid a lack of clarity over whether the president is pursuing a military goal or full-blown regime change. It was an extraordinary intervention again from the president yesterday. Speaking to reporters, Mr. Trump suggested that if the US had not launched strikes, Iran would have moved first.
We were having negotiations with these lunatics, and it was my opinion that they were going to attack first. They were going to attack. If we didn't do it, they were going to attack first. I felt strongly about that. And we have great negotiators, great people that do this very successfully and have done it all their lives very successful. And based on the way the negotiation was going, I think they were going to attack first.
Well, as oil and gas prices rise, President Trump ordered the US Development Finance Corporation to provide risk insurance for Gulf maritime trade available to all shipping lines. The US leader added that Washington's Navy would escort tankers through the Strait of Hormuz if necessary. Let's get out to Dan with the latest. Dan, is there any sign of the impact that statement is having in the direction the president would want it to?
Well, Ben, that's unclear at this stage, but I did want to walk you through why this is so important, because the shutdown of the Strait of Hormuz is impacting global trade, energy, of course, and global supply chains. And the first impact that we see here is on the shipping industry itself, because several of the world's largest carriers have already suspended transits through the Gulf and in the Red Sea, with many vessels now diverting around the Cape of Good Hope. If you take a look at some of the companies involved here, they include MSC, Maersk, CMA CGM, and Hapag-Lloyd. They've all either halted sailings or told ships in the region to hold position. And in fact, CMA CGM vessels operating in the Gulf have been told to seek shelter until further notice, according to reports. The energy market also under pressure here, with prices up and shipments down. Of course, the primary focus here is Qatar Energy, which has just halted LNG production in its entirety following drone strikes on facilities there. Qatar Energy accounts for more than 90% of the LNG passing through the Strait of Hormuz, and it has no pipeline alternative. Meanwhile, we're also hearing that the refiners across Asia, including Sinopec in China, Reliance Industries in India, and SK Innovation in South Korea, are all reportedly looking for alternative supplies. And that's because close to 90% of the oil moving through the Strait of Hormuz is destined for the Asia markets as well. And then on the oil front too, Shell and BP also reportedly holding back tanker transits through the corridor as insurance costs rise, but those companies have not officially commented on the situation to CNBC directly. And what we're also seeing now is this disruption starting to filter into global commerce as well. Companies including Amazon, Temu, and Shein all warning customers of delivery delays as we see these shipping routes between Asia and Europe also being rerouted. Now, President Trump has ordered the US Development Finance Corporation to provide political risk insurance and financial guarantees for maritime trade through the Gulf. The aim here is an important one, and this is why this is so significant. The president ultimately putting this plan in place, trying to lower the cost of war risk cover for shippers and to encourage traffic to return. But from a logistical and just a practical perspective, you'll probably be really hard pressed to find a captain who'll want to sail into a war zone in this environment. So whether or not this works remains to be seen. We may need to see perhaps developments on the war front first before we see genuine transits starting to resume. But no doubt for the industries involved, this is probably a very positive step in the right direction. Back over to you.
Brilliant, Dan. Thank you very much indeed for that. President Trump spoke to reporters in the Oval Office and addressed energy prices, saying he expects the spike to be temporary.
I have never had more compliments on something I did. People felt it's something that had to be done. So if we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
If they're lower than even before, that's going to be bad news for all the people who want to produce energy, isn't it? Just asking the question for a friend. Aldo Spagna is head of energy strategy at BNP Paribas Markets 360. Aldo, lovely to see you. I don't want to bring up other banks, but a big one that's over the road has just said that if this lasts 5 weeks, we could get to $100 a barrel. What are your thoughts?
Yeah, look, I mean, I think we don't know if it's 5 or 6 weeks, but if nothing changes, yeah. I mean, every week this Hormuz stays constrained, you're going to tick up. And you're going to tick up for oil and for gas. And I would expect gas probably reach it even before oil does, because you're losing barrels and molecules. So something has to change. Otherwise, every week we're going to price in more and more lost barrels.
Let me ask you about what the president just said there. And look, it could be a very real issue that if we do see a swift end to this and we see the geopolitical tension evaporating, again, they are very big questions. Could we trade lower than we were before, which was Brent in the mid to high 50s?
I think that's tricky. I mean, if everything resets, you will come off really quite fast, right? Because oil was already really positioned quite long before this happened anyway.
Yeah.
So I think the risk premium being priced out might be a pretty strong slope down for sure. Whether we go below the 60s, you still have a lot of risks in the system.
The message from a European lawmaker yesterday was quite serious about the consequences for Europe. Europe in a very different situation to other parts of the world on its energy supply. Yeah. How do we think about how Europe can weather short-term disruptions that may stretch into weeks and months?
Well, for me, if you're a net importer of both oil and gas, you're gonna worry about these price rises. I think for Europe, it's more a gas story than an oil story. Look, if you see where prices are going, as I said, they will tick up if nothing changes. We've seen what expensive gas does in Europe. We won't go back to 22, but it gives you a bit of a framework. This is not a good story for industry, right? Because they use all the gas. Don't forget that 2 weeks ago, we were all talking about gas storage in Europe being very low and maybe a big task to refill it. It's just going to get worse.
We are now battling a second crisis effectively after the Russia story. We've now moved on to the diversification story that has now been upended. How does Europe respond? Because we've got all different strategies around trying to ensure there's enough electricity for the AI story in future, for governments thinking about how to lower the price, not seeing increase, let alone the supply situation. So what happens next from the European perspective, do you think?
Look, so it all depends how long you have this issue. So if you lose the Qatari volumes to the gas system, there is no way, literally no way we stay in double-digit gas prices. We go in triple. If it comes back, then I think you go back to the narrative we had that from a European perspective. On the gas side, balances are going to lengthen because the US is still ramping up quite a bit of LNG capacity. Demand will taper off because we're exiting winter and weather is not bad. So aside from this disruption, the story for European gas is relatively bearish. I kind of believe in that. If we keep this, there's nothing that prevents you from the triple digits, but it's kind of binary for gas, it's particularly Qatari flows resuming through the Strait of Hormuz.
Elder, just interested to know how, the jump that we've seen in the oil price. I mean, some people might have expected it to have gone even higher. How much of that has been limited by the fact there was this expected, perhaps oversupply this year, and this is merely sort of chipping away at what had been those concerns? Yeah, look, I think there's two reasons why kind of the narrative is that oil price response might have been a bit underwhelming, I suppose. One was positioning. People were already quite long before this happened. So you need to compare it against a 60 price benchmark. The other one is, and this is interesting for oil, if you think about the market, I can think of at least 5 circuit breakers in oil. Right? China stocks, they're super high. So China doesn't need to immediately replace Iran. OPEC, SPR, US SPR. We've got pipelines in the Middle East that can to an extent divert. And we have a lot of oil on the water, floating cargoes. All of that stuff prevents the prices from exploding, let's put it like that. This is partly why oil is relatively muted. So positioning, and I think there's offsets. And this is why I keep emphasizing the gas. So gas doesn't have these offsets. Qatar doesn't have a diversion option at all. If it's closed, and you can't bring LNG out. But how long do those brakes work for? How long before they're pumping those brakes and then they stop working?
Also, when do they start working? For instance, OPEC Plus, they set 206 KBD on Sunday. They've got 1 million more probably, or at least of the 1.6 they're unwinding. That will, I don't know if they want to do it all, but it will take time to bring into the market. It is, look, once you have the diversion pipelines that you can keep on doing, unless the infrastructure there gets constrained. We never know how this works. So in terms of length of divert, I think you're probably okay. Floating cargoes by definition is a short-term thing because you unload a cargo and then it's gone. That's all the other ones are kind of potentially longer-term offsets, but of course constrained by volume. Look, IEA strategic stocks are 1 billion barrels. US has 400 million in SPR, 370. So that's the limit of that's the size of what you can do.
A fascinating point. It's going to circle back to China because we are gearing up for a 5-year plan later this week on Thursday. And so far what we've seen out of the Chinese market, resilient despite the threat of trade tariffs. But now we know that there are different energy routes that are potentially closing for the Chinese, Venezuela being one of them, and now when it comes to Iran. What does that mean for the Chinese in terms of its energy sources?
Yeah, it's a good question. Look, it kind of justifies the story we've had on China for the last year and a half. They're building much faster and to much higher levels than we thought in terms of oil stocks. This is exactly what you do, because I think almost every supply source is at risk, as you say. So that means that strategy was the right one. And it now means that there's a decision to be made that, let's say we get structural disruptions in oil, crude goes up. I think that means for China, if you have 1.2 billion barrels in storage, you don't immediately dip into the spot market to replace it, you take it out of storage, so you destock. And that partly keeps the price level, prevents the price from going up too high, I would think. The question is, to how far do you want to do this? Look, they have a lot, 1.2 billion is a lot. So I think they can do this for quite a while. So if I probably need to go into months, quarters of strong disruptions before this becomes an issue. Anything shorter than that, I think China can manage, and they'll probably feel vindicated in their strategy.
China can, and we've focused quite rightly on the supply side because this is a supply side shock. But becomes a demand problem the higher we get, because China, reason why it has such a full SPR, one of the reasons is because they don't need the oil, amongst other things, and obviously they've taken advantage of relatively lower prices, and others don't have a demand problem globally. So if, again, that lot over the road just talked about demand destruction, where does demand destruction start to come in? Because if that happens, this is a global economy rather than an oil economy problem.
Yeah, look, I mean, I think you want to be higher than where we are today. So demand destruction should happen, at least in sizable form. I think you want to be at least at a 9 handle and probably in the high 90s. Then I would say you start to build significant incentives to significantly take out volumes. You probably see demand destruction with oil already if it's kind of optional, but 83 is a price that's not comfortable, but we've seen it before.
All right, let me just chuck a number at you. I've got 20 seconds left. $100 a barrel. Do you think we see demand destruction?
Yes.
Okay. There you go. That's what I'm hearing. Aldo, lovely to see you. Thank you for joining us today. It's really fascinating to hear your thoughts. Aldo Espana, who is Head of Energy Strategy at BNP Paribas Markets 360. For more on the Trump administration's shifting narrative as the Iran war continues, head to CNBC.com. Our writers are putting so much copy out there for you. Absolutely superb stuff from the .com team, so a shout out to them. And on a programming note, our US colleagues will be speaking to the US Treasury Secretary Scott Bessent later today. Don't miss that conversation at 12:30 London time. I'm especially interested to see whether they ask him about the directive from Trump to stop doing some business with the Spanish. I mean, really? Wow.
Indeed. And also coming up on the show, President Trump slams Spain, saying he wants to cut all trade as that defence dispute grows. We will discuss. Plus, the UK also draws Trump's ire, with the president lashing out at Prime Minister Keir Starmer. Not once, not twice, but for the third time in 24 hours. And FCC Chair Brendan Carr criticises what he calls Europe's protectionist policies. We'll bring you more of Arjun's conversation later this hour.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
President Trump said he wants to cut all trade with Spain after the country refused to let US forces use its military bases in its attacks on Iran. Trump added that Spain did not have good leadership and criticized its contributions to NATO. Well, Charlotte joins us with more on this. Charlotte, this was a direct attack at Pedro Sanchez and his leadership, but military bases, the UK was under fire for its initial approach here, but Spain very much attracting the ire of the president.
Yes, and this is the latest spat in many spats that we've seen over the past year between Trump and Pedro Sanchez. Now, on Sunday, the Spanish Prime Minister called the US and Israel's attack on Iran an unjustified, dangerous military intervention in violation of international law. And that's why they decided to bar the US from using these two bases in southern Spain as part of their operation in Iran. They said it said that it was in violation of the United Nations Charter. And of course, we heard then from President Trump yesterday, basically threatening Spain with a trade embargo.
Spain actually said that we can't use their bases, and that's all right. We could use their base if we want. We could just fly in and use it. Nobody's going to tell us not to use it, but we don't have to. But they were unfriendly, and so I told him we don't want to. Spain has absolutely nothing that we need other than great people. They have great people, but they don't have great leadership. And as you know, they were the only country that in NATO would not agree to go up to 5%. I don't think they would have agreed to go up to anything. They wanted to keep it at 2%, and they don't pay the 2%. So we're going to cut off all trade with Spain. We don't want anything to do with Spain.
And of course, you heard there President Trump talking about Spain's contribution to NATO. We know that has been one of the points of contention recently, Spain refusing to reach the 5% target, saying that they will stick to around 2%. Of course, a decision that's been difficult to understand for a lot of NATO allies, especially given the big growth that we see in the Spanish economy. But there's been multiple spats over the past year between Pedro Sanchez and President Trump. China has been one. We know that Pedro Sanchez has been traveling multiple times to that country, wants to be basically make Spain the bridge between the two countries. He's going actually back in April for his fourth trip in 4 years, and we know the US has been quite critical in that effort to rewarm the relations with China. The question of Gaza has been a difficult one as well. Spain recognized the state of Palestine back in May 2024. Venezuela has been one earlier this year. There's a massive diaspora from Venezuela living in Spain, and massive Spanish corporates have operations in Venezuela, whether it's Repsol or Telefonica, and Spain has been critical of the operation there as well. And we know that Spain, of course, is one of the most left-leaning government in Europe, and they're kind of taken the lead, being openly critical to President Trump. But we see other governments trying to, round the corners and be a bit friendlier in their tone. We know Spain has just taken it face on, and that benefits him domestically, because we know that the public opinion in Spain is kind of in favor of everything he stands for. And he's an unpopular prime minister who wants to run again next year in an election, and posing as the anti-Trump persona kind of works in his favor.
Can the Americans place an embargo on Spanish product? Is that even legal?
So that's the thing. Spain is kind of shielded, can do this criticism because they're kind of shielded within the EU. Of course, this is where the trade relations are being managed. Now, they would have apparently legally to show that Spain is a direct threat to the US to be able to impose this kind of limits, and not allowing them to use bases on their own territory wouldn't be potentially one of these reasons. So that's one of the things. Also, Spanish export to the US account for around 1% of Spanish GDP. It's olive oil, chemicals, auto parts, but they're kind of shielded compared to other European countries as well. They are way less exposed to the US.
Good job that Spain got so much support from Herr Merz yesterday when he met with Trump, didn't he? Or not. Merz was playing a different game, I think, yesterday. Anyway, that was quite fascinating.